Today, folks, there has only been one strategy that has worked so successfully over the last 15 years that if Warren Buffett didn't implement this, in his retirement, investors would have looked at Berkshire Hathaway so dramatically differently, and they would have said he's behind the times. And you know what I'm talking about. It is big tech. Big tech continues to trade like mid to small cap companies, and I'm not talking about their stock prices. I'm talking about their damn earnings growth rates, because the after hours today was nothing short of astonishing, with Meta up 8.2%, thanks to those that sold me their Meta shares into close. I'll show you my Meta shares in a moment here, but also Microsoft up 7%. These are multi-trillion-dollar companies, guys. Nvidia, obviously CapEx is looking to continue to expand from these mega tech companies, so Nvidia is getting the benefit of that, continuing to hit all-time highs, making me ever more grateful that though I touted the market was expensive, but I'm always sitting here just saying, hey, let's wait till earnings. Earnings will be the defining factor to where we go from here, rather than the bears that just say, oh, it's like the dot-com bubble. You can't own this market. Go more into treasuries. Look at option ETFs. Go toward SCHDs of the world. And I'm ever more thankful I dumped my SCHD and pivoted it back into the S&P, because I made a lot more money in a very short period of time thanks to this bull market. But we got to break this down. So if you're on a path to financial independence, if you damn well one day want to retire early, come to where the transparency and the truths resonate in this channel, because man, I'm a total return guy. I'm not here to bullshit you. Subscribe, join me on your journey. Let's do this together, guys. We'll start with Google, because I'm just a little disappointed Google's been lagging against these tech companies, considering its earnings were just as jaw-dropping. But between my wife and I, our two biggest positions are Meta and Google, and we have these split between our accounts. We both own shares. She's got the bigger Meta position. I've got the bigger Google position, and both these are starting to perform and lead us to outperform the broader markets. With Google, I got 91 shares in this account, $174.15 at an average buy. I'm up 12% as of closing today. In this account, I got another 87 shares, average by $176.21, up 11.5%. In this account, I did buy a few more Meta shares before heading into this earnings, so it did bump my average cost up quite a little bit, because I was buying Meta, I think, down at the 530, 540 range when it took that major dip, and I pat myself on the back for this one. But I did buy a few more on the way up here, so it did bring my average buy up to 627, 13 shares. And obviously into close, I was laughing, because I was like, oh my God, people are actually selling out of their Meta shares, because it dropped to 695. And obviously they greatly regret that, but I am up 10% at 695, and now probably up 20% into after hours, let alone the wife's position that she's been holding literally since the third week of March 2020, the bottom of the market of the pandemic. So she's up hundreds of percent. Meta's been our best performing position, hands down. But my goodness, with the exception of Tesla here, guys, I want to just look at these numbers, because like I said, it is just disgusting. I mean, it's nothing short of just insane. I mean, Meta and Google are our two biggest positions for fundamental reasons. At the end of the day, I'm always a fundamental investor, and if these earnings change in any material way, I'd obviously sell these positions down or even completely exit them. But when you're looking at net income growth of 36%, and Meta's trading usually between a 25 and a 30 times multiple, that is cheap. If that continues even for the next couple of years, guys, that is insanely cheap. I mean, look at their earnings went from $5.16 a share to $7.14. I mean, we're talking about a company growing revenue right now at 22%, going from 39 billion to 47 billion. They have half the world's population basically utilizing one of their apps every single day. I mean, look at Threads. Threads is growing to the size of X. It's over half the size of what X is. And it hasn't even been around that long, guys. They're monetizing WhatsApp, the most used global messaging app. So they're seeing 6% growth rates on their daily active people. Like, you know how crazy that is, guys? Everything else is double-digit growth rates. Like, come on. We know the future is going to be in these tech companies. So why crap on Mark Zuckerberg because he's poaching all the AI talent and, trying to acquire and do like really dirty bid ups to extreme valuations on AI stuff when you can afford to do it? I appreciate him doing that. We know that these are the few companies that are going to control the AI infrastructure, because nobody can compete. It's a multi-$100 billion expense. So, I mean, it's going to be like the telecom giants. Eventually, the government's going to step in and call them monopolies and force them to let other people utilize the infrastructure. I mean, that's the way this is going. And I'm damn happy to be a part of it, right? I mean, look at Microsoft. I do not like Microsoft's valuation. I wouldn't have bought it going into earnings, but I mean, they are justifying it to some extent here. 40 PE is a bit rich for my taste where they currently sit, but revenue is up 18%. Are you kidding me? Net income is up 24%. But you got to ask yourself, would you rather buy Microsoft with net income growth of 24% at a 40 PE, or Meta at like a 27, 28 PE, but 38% or 36% net income growth? This is why we pick Meta. This is why we pick Google. But I also use these advertising platforms, so I'm a lot more comfortable with their business models, and I feel confident in these stocks making up 15% of our portfolio value. But I'm not selling them right now. I know I said I'd sell Meta or Google if they started to extend to certain values in our portfolio. I did sell Take-Two Interactive, as many of you know, and I actually bought more Google with that and put most of it back into the S&P just to bring down our individual stock weighting. But I always love kind of focusing, or basically cost averaging into the many and focusing on the few. And our few right now are just Meta and Google, and I'm going to let that go idle probably for longer than I initially thought. We'll see if Google gets past that 220, 240 range. Maybe I'll sell a bit, but for right now, I'm just sitting pretty laughing at the absurdity of listening to like option ETF investors, dividend investors getting absolutely crushed in this market, knowing what they're currently seeing on earnings. And it's been the trade of the last 15 years. There's never been a market cycle like this where it's been so obviously presented to you. If you've just done a little bit of research, a little bit of homework, could have led to excelled returns. Now, I'm not a financial advisor. I'm not saying this is going to work in perpetuity. I'm grateful I've been able to capture it over a decade, and I'm continuing to, but we'll see if that can persist into the future. Hopefully I'm not coming off too cocky, but we are seeing it in earnings. I mean, we saw PayPal get crushed, United Health. Like, I'm seeing a lot of people try and trade all these other companies, and they cannot stand up to the numbers that these tech companies are posting, guys. So just keep your investments simple. Don't get too creative with anything. Cost average in the S&P, I don't see how you lose at this time. And right now the S&P is like 70% of my portfolio, and with the Nvidia bump and Microsoft and these mega tech companies continuing to push higher, we're going to be at all-time highs tomorrow. I just don't see how we're not. But yeah, it's been disgusting watching our portfolio growth, which is why I pivoted a little bit to focus more on paying down the mortgage in this bull market. But I'm not going to stop cost averaging, right? But we'll see how all this turns around. Maybe we'll finally get the divergence between the little bit of VDY that we own. I think VDY is less than 20% of our combined portfolios, but VDY was like crushing the S&P over the last year or two. But with these recent earnings, something tells me the S&P should hopefully start surpassing the returns of my dividend ETFs, but we shall see. I'll pass the question off to you, though. I'd love to know how you're looking at these tech earnings, guys. What are you doing with your portfolio? I'd love to hear about all of it in that comment section below.